Hello, everyone. Welcome to the webinar today. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. So glad to have you back with us. We are going to be talking about several different strategies today to defer those pesky capital gains. And so I hope you stick around for this whole presentation. But before we begin, I do want to go forward with just a few housekeeping items. As usual, we are recording this whole thing. We are going to be sending you the recording tomorrow, along with the PowerPoint slides, and our speaker, Scott Varney, will send you his information as well if you want to connect with him after the webinar. And I'll start off by telling you a little bit about Scott. Scott has done several webinars for us over the last 3 to 4 years about capital gains. He always likes to share something new, and his background at SV Consultants is basically he's a strategist and he's a very well-versed financial services professional. He helps clients think through all of their options to defer, reduce, or eliminate capital gains taxes altogether when they sell a highly appreciated asset like real estate. And he has a background in real estate as well as a top 1% producer nationally in the realm of residential real estate when he was a broker. He enjoys being with people and loves the opportunity to help solve some challenging issues. So he is a problem solver, and we have a problem, right? Capital gains taxes. So he's going to go over all of those strategies. We will have some time for questions at the end. So if you do have a question, please put it in the question box, not the chat, so that we don't miss it there. And that'll help us keep real organized. We'll have basically hopefully an hour or so, but it might go over with questions. So if you can't stick around, again, we are going to be recording the whole thing. Scott will also be addressing questions offline if we don't get to your question for some reason. But let's stick around as long as you can. Thank you so much, Scott. I really appreciate you coming on and talking to our group again.
Oh, always glad to do that. And for those of you that don't know me, hopefully I didn't ruin your blessed life just now. But I just enjoyed some time with Alexandra. I have an education platform doing interviews with different professionals in the capital gain space, estate planning space, and started doing some with Alexandra on the property owner space, so on landlords. And so, anyways, we're going to go ahead and get started. Alexandra's already done a wonderful job uh, actually introducing me. So, I used to close 50 to 61 clients a year as a real estate professional. I got my financial services licenses back in 2014. So, I do the life and long-term care as well as annuities. But mostly, I've been operating as a capital gains tax strategist for the last 7 years. I started as a one-trick pony, and I like that term because my wife, you see there, she owns a horse. My daughter owns two horses. That means I have to work like a horse to keep up with all of that. All right, so how do I operate my business? So in the world of sales, because in the end, consultants, they do sales. Two types of professionals that do sales. One is the types that try to make a client fit their product. You've probably experienced that, where people are trained to overcome objections because they're trying to get you to buy their product or their solution. And I started in the capital gains space with one solution. And so always looking to see who could fit that, but I'm just not one to try and make everybody fit that. Then there are those that find a product or a solution that actually fits their client. So they have a broad spectrum of options and they go, okay, this is what your needs and your goals are, your finances. This option seems to be the closest fit to what you are trying to accomplish. Now, while this is general information about various capital gains tax strategies, it does not constitute legal advice. The best way to get guidance on your specific legal issue is to contact an attorney, which, by the way, in case you need, if you have a really complicated 1031 exchange case, a friend of mine, a tax attorney out of Hawaii, actually was involved in the meetings with the IRS in the 1980s to develop the rules of the 1031 exchange. The three identification rule, the 200% rule, the 95% rule. So he was in those meetings, so he knows that really well. I am not a 1031 accommodator, but I have really wonderful connections. Now, if you leave this webinar overwhelmed and confused, feeling like this, you're normal. There is a lot of information here. There are a lot of options that people don't realize are out there, mostly because they work with tax preparers instead of tax planners. And the tax preparers, plug and play professionals, are not out there trying to find the options. They want to keep everything vanilla. And most of the time I'm talking to prospective clients, they're upset with their CPAs because their CPA didn't tell them things that I taught in the webinars. Well, that's because they're not tax planners, but tax planners cost more money to help you save on those taxes. The big takeaway for today is understand that you no longer, or your clients no longer, have to be stuck in a 1031 exchange system of thinking. There are other options out there. And even within 1031s, there's some really wonderful options. Couple of quotes. In America, there are two tax systems, one for the informed and one for the uninformed. Both are legal. I love that quote from Judge Learned Hand. So you may be about to step from the uninformed to the informed. Another quote. The biggest scam in life is paying taxes on the money we make, paying taxes on the money we spend, and taxes on things we own that we already pay taxes on with already taxed money. I'm sure you're feeling it. Those of us in California, I tell my clients around the country, we pay a weather tax. And I remember one guy from Florida, he got up in the computer, weather tax. It's like, yeah, we love the weather, so we stay here and pay all these crazy taxes for the state. Now, the current capital gains tax rates. Now, this is very important information for you to understand. The current rates are 0, 15, and 20%. When people come to me trying to project their capital gains bill, they've done their calculations based on a progressive tax. In ordinary income tax, everything is progressive. You're going to start with a 10% bracket. So a part of your income's at 10%. Part of it's at the next bracket. Part of it's at the next bracket, going all the way up to the top bracket. With capital gains, once you hit 20%, all of it is taxed at 20%. It is not progressive. And then when people do their homework and they find that if they're married, the bracket for 20% to get there is $583,750 to get into the 20% bracket. So what they'll do is they'll say, you know, I only have 400,000 in gains. I didn't meet that threshold of 583,750. What they don't realize many times is that you have your capital gains, but they also add your income. So if that person had 400,000 in capital gains, but their adjusted gross income was 200,000, that puts you at 600,000. That puts you in the 20% bracket. So they take your capital gains plus your income to determine the bracket. Now, when you pay the taxes, it's subdivided out, but they combine it to get there. Now, there are proposals that are we've been watching for a while. They want to raise the capital gains tax rate, the top bracket, from 20 to 28%, but anything over $1 million in a year would be 39.6%. So basically, they want to double the highest bracket. And what that means is if you have a $2 million gain, $1 million of that's going to be at 39.6%. They want to increase the Obamacare, the net investment income tax, from 3.8% to 5%. Then you have your state taxes. In California, they have proposals at 14.4 and 16.55% to raise the taxes, which, by the way, if you're in California and New York and Michigan and about a dozen other states, they're looking to have a long-term care tax added to that, which could be 0.5% to another 1%. Recent 1031 exchange proposals, people ask me a lot, all the time. Are they going to get rid of 1031 exchanges? I don't know. But that's been on the table and discussed for 3 or 4 decades, actually. So going back to late 80s, mid 90s, they've been trying to discuss maybe getting rid of that tax code. But here's the compromise solution that they have proposed. They want to, and again, it's a proposal, they want to cap how much gains can be deferred in a 1031 exchange at 500,000 per person. So if you're married, that's $1 million per couple per year. So if you have an industrial building that sells for 4 million, and if it's 2 million in gains, you can defer the cost basis, the 2 million plus 1 million in gains. So you could do an exchange with 3 million, and then you have to pay tax on the other million. That's if they accept the proposals, if they vote on the proposals. That could be a problem. Now, in the capital gains world, there's multiple strategies that follow tax code 453. Really good strategies. But we have to look at timing. Because of the proposals, remember 20 to 28% or 20 to 39.6% for the capital gains top bracket. Timing is everything. Tax code 453, you're spreading out your capital gains. So if you do like an owner carry, you only pay the capital gains on the income that you receive in that year, the principal you receive in that year. So if you did a 10-year owner carry and you got paid 10% per year, you're only paying 10% of the capital gains. People will do that, or any of the strategies that follow that, like structured installment sales, deferred sales trust. People will do that sometimes to go from the 20% bracket down to the 15. Sometimes we can get a client down to the 0%. We did that not long ago with somebody out of Florida. We got them to the 0% bracket by planning it out well with their CPA. They want to go from 20 to 15. That saves them a little bit in taxes. However, if the current proposals get approved and voted on and are increased, the client may go from 20, instead of going from 20 to 15%, they may go from 20 to 22, 23, 28%, or 39.6%. Not likely in the top bracket. You'd be having to sell $100 million building to get there, but with this type of strategy. But you could end up paying more in taxes by spreading it out. And so we have to really look closely at the numbers. So it could be bad timing. Now, once everything's approved and we know what the tax brackets are going to be for a while, then it makes sense to do these strategies, without having to worry about all the numbers. Now, another note is everything is fact determinative. That is a term that I was taught from a tax attorney who's licensed to go to tax court and fight the IRS in court. And she said that everything, it comes down to how it is set up, how it is managed, and how it is reported. One case can be allowed by the IRS, while another case following the same strategy can be disallowed. So everything is fact determinative. This is why you have to work with your tax professionals. Make sure everything's being done right. Work with legal counsel. All right, the agenda for today. So we're finally getting started. Timing is everything. I actually wrote an article for the AAOA magazine about timing. There are those strategies that have to be set up before closing. Some can be done within 1031 exchanges 45-day identification period. There's a way to rescue a failing exchange after closing, but no exchange was involved. And then there's an income tax mitigation strategy I will close with. If you do have a QR code reader, this may be a good time to open it. I will have 2 QR codes at the end of this presentation. All right, so let's start with those that need to be set up before closing. Charitable trust. Charitable trust. Now, it's very rare to find strategies that eliminate capital gains taxes. Most of them will defer them or spread them out. But to eliminate them, the capital gains, there's only a couple of strategies. Charitable trusts are a means to actually eliminate the capital gains taxes on any appreciated asset or even a business. I just did a presentation yesterday for the California Business Broker Association, and we talked about how we could use this even for business. The asset must be in the trust when it is sold. So what happens is you have to set up the charitable trust, then you donate the asset to the trust. You get a significant tax deduction that could be carried forward up to 5 years to help with income taxes. And then the trust sells the asset and gets the tax mitigation. So it has to be set up in advance. Investment properties can be a part of a charitable trust. Now, one thing about charitable trust, as well as other charitable strategies, an appraisal is required to determine the value of the asset donated to the trust. Why? Because the IRS knows that people tend to overvalue assets when they donate them. So when you're talking about things like real estate or other assets that are donated, they want an appraisal done. And it makes sense as to why they would do that. But the charitable trust will have to have an appraisal done every year to determine the value of what is in the trust. Now, when you're looking at the numbers, you got to look at the full picture. With a charitable trust, the cost will be the attorney's fees, $4,000, $7,000, $10,000, whatever it costs to set up the trust, plus 10% of the asset value has to go to charity. For example, if you donate $1 million asset to the trust, $100,000 has to go to charity. Now, if that $100,000 goes to charity immediately after the sale of the asset, that's what they call a charitable lead trust. If you make it so that the last $100,000 in the trust goes to the charity, that's the last of the distributions, that's what they call a charitable remainder trust. Most people do the CRTs because they want to invest the monies while it's in the trust waiting for distributions. And so that $100,000 that would have gone to charity, you can grow that for a time and then give it to charity at the end. Now, limitations. All strategies have requirements, costs, limitations that you have to deal with. Proceeds are not fully liquid immediately. Typically, you end up waiting a year before distributions start. Those distributions can be 5 to 50% annually, so 2 to 20 years. And again, it starts a year later. Now, the higher the distribution, so if you want to try and pull it off in 2 years, 50% per year, that means the lower the actual tax deduction that you are going to get. So you have to work that out with your attorney to look at those formulas. Up here in Silicon Valley, where I'm at in San Jose, a lot of the tech people will actually do the trust for their stocks because they want to sell off stocks and buy a home. And so they'll do the 50% per year. So they have a lower tax deduction by doing that. Work that out. Those of you that have living trust attorneys, your trust attorney may already know how to set these up. So you don't need to go through someone like me to have those discussions. You can go directly to your attorney. Now, another limitation is that the asset needs to be free and clear of debt. On rare occasion, you'll find an attorney that is okay to make an exception if the debt has seasoned for at least 5 years. But typically, they want the asset to be debt-free. And then when the asset is sold in the trust, those funds can be invested because you don't want those funds sitting static. If the markets are growing, and of course we have inflation, you don't want to be losing out. You want to invest. You can do that with some tax mitigation advantages. LLC with charitable intent. I'm going to go over about a dozen strategies here. There's a lot out there. This is a great strategy for the sale of businesses and real estate. This strategy can accomplish great tax mitigation and create a significant charitable deduction at the same time. Typically, we're looking at $1 million minimum. The attorney groups that I am connected to don't want to do anything less than a minimum. It's expensive. This could cost anywhere from 40,000 to over 110,000, depending on if you include attorney's opinion letters and whatnot. It gets expensive, but we have to look at the tax bill to see if it makes sense. Now, what's going to happen is you're going to set up an LLC with charitable intent. You're going to donate the asset or the business to that LLC. The LLC is going to sell the asset. So let's say it is $1 million. It's going to sell the asset. Eventually, the $1 million or 999,000, because you have to pay tax on 1% of the gains. That $999,000 is going to be donated to charity eventually, not immediately. Now this is the LLC with charitable intent. It's going to loan the client funds to purchase a high-end cash value life insurance policy. That is going to still tie up the funds. Then what happens is that death benefit is going to be really, really high, 10, 20, $30 million. Now, they bring in a lender who's going to loan you the money against the death benefit. So the way you get your cash is actually from the lender. And what's going to happen is when you pass away, the death benefit is going to pay back the LLC, all the funds that loaned you to buy that high-end life insurance policy. And then the LLC will at that time make the donation to charity. That life insurance death benefit is going to pay back the lender. And then if there's anything left, that goes to your beneficiaries. So that is a way to actually address the capital gains tax bill. You are going to pay 1% on that. And for those who have a significant balloon payment, I'm working with somebody right now where almost 3/4 of his gas station and business sale is going to be paid in a balloon payment in 3 years. If everything is set up in accordance, to what can be done with the LLC with charitable intent, this can be helpful even with the LLC with charitable intent balloon payment. Depends on the contracts, the structures, all of that. So, but this is a transactional type of strategy. You will have to go through this again. If you have multiple significant valued properties, if you set it up with one, you'd have to set up another one for the next property. So these are transactional, so those costs can add up. But again, if the tax bill is high enough, it could make a lot of sense. So here 99% is going to charity, and you still get your money to go do stuff with. So in the process, so it's really a win-win situation if you're a person that really likes giving to charitable organizations. All right, complex spendthrift trust. This can defer capital gains taxes for generations, passive income taxes, that's your rental income, or even stocks, bonds, mutual funds, cryptocurrency. As it's growing, you can defer the gains on that for generations, the taxes. For those of us who are self-employed, this does not work for W-2 employees, but if you are self-employed, like myself, I have these trusts, you can defer up to 50 to 90% of your income taxes, depending on your business structure. I'm deferring about 60% of my taxes last year. So this could be very valuable even for business owners. It provides ironclad asset protection. So 40% of LLCs and corporate structures are pierced in court in a lawsuit. So 40% of the time you lose your assets anyways, even in LLCs. So this is much more solid asset protection. And I had 2 conversations on Tuesday with clients, one near 20 million, another one near 30 million in net worth. Well, This avoids the estate tax because you sell the assets to the trust while you're alive, and when you pass away, the trust still owns the assets, so there is no estate or what we call death tax. Now, these trusts are not cheap. You're going to run $20,000 to $40,000 a piece, depending on how many business structures you have, investment properties you have, all of that. And if you have a business, that could be an extra $15,000 to $20,000 to get that set up. But it gives you the long-term tax mitigation. And one thing to note is this is not transactional. Once you set up a trust, you can do multiple transactions. So it's not a singular transactional type of strategy like the LLC with charitable intent. You can, if you have a dozen investment properties, you get them into the ownership of the trust, and then you can sell off each one and ride off into the sunset, and defer the capital gains taxes for generations. I have a presentation in May on this. At the end of the time, I'll also post my contact information, but Alexandra will be getting that out. Asset needs to be in the trust when it's sold. So you actually have to pay for the trust in advance and then sell the asset to the trust, and the trust gets the tax mitigation. So the LLC with charitable intent and the complex spendthrift trusts are hard for clients because they do have to pay in advance to get things set up. Whereas some of the strategies will just come out of your net sales proceeds. And people, even though they see the numbers and gives them a gut punch, they never have to pay it out of pocket. Now, if you have a listing now, or you have a property under contract now, it could work with this trust because no seasoning is required. But I have to walk through the numbers to make sure it makes sense to do these types of trusts or any strategy. It's got to make sense. Now, traditional installment sale, we know this as an owner carry. This follows tax code 453, which I said anything in the 453, you have to watch timing, unless it, in the 453 strategy, if it defers the taxes for 20 or 30 years, that's a different story, but most of them are spreading it out where they're paying you each year. So it becomes a lender for the buyer for a specific period of time, and then as the seller collects from the buyer each year, the principal is going to be taxed at the capital gains tax rates. Interest that they earn from the buyer is going to be taxed at ordinary income tax. Now, if you set it up where they pay for 4 years and then there's a balloon payment in the 5th year, well, we could look at other strategies to see if there's a way to mitigate that at that time. There's a couple strategies typically available at any given time to help with the balloon payment. Structured installment sales, same thing, tax code 453. It's spreading out the capital gains taxes for however many years that you set up in the contract. Your funds, you don't touch the funds. And that's the key with these 453 strategies, is the moment you touch the funds, they go to your account, you have constructive receipt, the tax bill is due. So 453 strategies, the funds have to go somewhere else from the closing agent. So if it's the closing attorney on the East Coast, title company in the center part of the country or on the West Coast, those funds cannot go to you. So in this case, it goes to a capital asset dealer, someone who sets up these types of structures. Now, this can be set up with a life insurance company as an annuity to create more security and guaranteed payments. So versus an owner carry. Owner carry, a lot of times people are nervous that it may come back to them. The buyer may default. Actually, I know investors that hope the buyer defaults so they can get another large down payment and high interest rates. So I've met people who have actually had properties be defaulted on 2, 3, 4 times, and the owner's making out like a bandit. But most people that are doing that are not hoping for that. But if your funds come in to the closing table and it goes to a holding company, and the holding company buys an annuity, and then you set it up to have that annuity paid out over the next 3 to 40 years, then you only pay capital gains each year. And we did this for a client in Florida where we spread it out enough, ran the numbers with their CPA so they could get into the 0% capital gains bracket should it continue on to have a 0% bracket. So this can spread it out. You have those guarantee payments and annuity with a little bit of growth. These are not the high growth types of annuities. This is there for your tax mitigation. And you can't call your insurance company and say, I want to do this. This is a very specialized type of product. So there's very few insurance companies that do this. Now, if the capital gains exceeds $5 million per person, so if you're married, $10 million, the IRS, anytime you do a 453 strategy, the IRS will want you to pay interest on any gains deferred over $5 million per person. So that's where you talk to tax attorneys about doing series LLCs to mitigate that. And most people do not fall in that. Now, in some cases, there needs to be no debt on the property if the seller wants full tax deferral. A lot of times, if you're using an annuity, there cannot be any debt. So you're going to have to pay a proportionate amount of gains taxes. You have your mortgage boot. And so you have to pay taxes on that part of it. And the balance of it can go into the annuity. All right, 1031 exchanges. This is a means to defer capital gains taxes for as long as you own the real estate. If the tax code still applies in the future, you can hold on to the real estate until you pass away and the beneficiaries get a step up in basis, which can eliminate the capital gains taxes. Understand, that is on the table to be eliminated. So they've proposed to eliminate that. Will they? I don't know. Wealthy people have a way to keep tax strategies in their favor. Now, what's a step up in basis? If you bought a property for $200,000 and you sell it for $1 million, you have to pay the $800,000 in capital gains, the taxes associated with that. If you bought it for $200,000, you pass away, it's worth $1 million. Your beneficiaries get a step up in cost basis so that if they sell immediately, there's little to no capital gains taxes. But understand, this varies from state to state, where it may be a full step up in basis and maybe a 50% step up in basis. So you have to understand your state rules on that. So, but people will do what they call swap until you drop, hoping that their kids can inherit the properties and pay no taxes. This cannot be set up after closing. This is in red and bold for a reason. You already have constructive receipt, even if the attorney or title company still has the funds. I get people that have called when I was partnered up with a 1031 exchange company. They say, hey, I closed a week ago. I want to do an exchange. And I have to tell them the bad news. I'm sorry, but the title company still has the funds. I haven't touched it. I'm sorry. Once it closed, you have constructive receipt. There has to be a contract in place in advance of the closing. So you have to do this in advance. Now, a lot of confusion on replacing with like-kind property of equal or greater value. People will think if they sell a single-family residence, they have to buy a single-family residence. Actually, like-kind is broadly defined in the realm of real estate. You can sell a single-family residence and exchange into a hotel, motel, or office space. It doesn't have to be the exact type of real estate. It's within the broad class of real estate here. So all of these options are available that you can move from one option to another. What is not like-kind real estate? Primary residence. You have what's called the 121 exclusion or exemption, depending on what you call it. That's that $250,000 per spouse exemption. Originally, when 1031 exchanges were put in the tax code in 1921, it was, I like your house, you like my house, let's swap, and there's no change, no tax. But after the Starker case in 1979, 1980, it became more about the investment properties, and they provided late after that the exemption so that you can't exchange a primary residence. Second homes do not qualify many times, but talk to your CPA. Maybe it can. Real estate flips, that's not going to qualify. When you do an exchange, you're holding for long term, and it's an investment property that you're going to rent out. So flips don't work, but flips can work in that complex spendthrift trust where we could defer up to 90% of the profits on those flips. Real estate developments do not count, but again, that could work with that complex trust. Real estate investment trusts, known as REITs, typically are a membership interest in a trust and not exchangeable. It actually has to be real estate with a legal description to be exchangeable. And REITs typically do not have that because you've invested in a trust. If the REIT is considered real property and has the legal description tied to the ownership, it's not a partnership interest, then yes, you can exchange a REIT, and you need to talk to the tax professionals on that. This is another shocker. You have to replace debt with equal or greater debt. So I've talked to people that they've sold an $800,000 property, they paid off $300,000 debt, they just want to exchange the cash that was left, thinking they could do that. And when they're told, no, you have to replace that $300,000 debt with $300,000 of debt, or come out with cash out of pocket of $300,000, or you pay taxes, they're in shock. I didn't know that. Now, maybe their credit score isn't so strong. Maybe it's harder to get a loan. Interest rates, maybe a little higher. I'm sure we all feel that right now. The interest rates have gone way up, back to actually more normal over the last 60 years. So you have to replace debt with equal or greater debt unless you come out of pocket to replace it with cash. Other rules: 45 days to identify property, 180 days to close the identified property. 40 to 60% of exchanges fail because of various markets or market conditions, whatever's going on. And here's a little bit of an insight for you. If you do not identify a property, the accommodator can release those funds on the 46th day. So you have 45 days to identify. If you do not identify a property, they can release those funds on the 46th day. They're not supposed to release it until then if they're applying the rules. If you do identify a property and do not acquire it, the accommodator is not supposed to release those funds until the 181st day. They have to hold it an extra 135 days. So the way to reduce the risk of that happening and the client being stuck waiting 6 months to get their money, do not identify a property unless you actually have it under contract. That increases the chances that you're going to close. Now, you still have to identify within 45 days, but make sure you have a property under contract before you identify so that they can, because if that way, if you don't find a property, then you can get your funds back a lot sooner, 4.5 months sooner. Now, private family foundations, like a public charity or public foundation, is dedicated to carrying out a charitable mission. However, a private foundation is not a public charity because instead of receiving public support, it is funded and controlled by an individual, a family, or a corporation. You have the Bill and Melinda Gates Foundation, the Walton Family Foundation, the Coca-Cola Foundation. Those are self-funded by their organizations. Now, these foundations can address income taxes, capital gains taxes, and estate taxes. The key to foundations is that you have to have legitimate charitable intent with your resources. You have to be engaged. You have to be involved. There's a certain amount of time you have to put into it. That's why we see these professional athletes have their foundations. Well, that's for tax mitigation purposes, but also they're out there with the kiddos, with their foundations. They're doing charitable work because they want to. So they get both the benefit of really helping the community and tax benefits. So you have to be one that is wanting to be involved in that. And this can eliminate capital gains taxes, but you have to pay a nominal excise tax. I think it's still 1.39%. This you have to be donating on an annual basis. And so this doesn't make sense as a transactional type of strategy necessarily. And the tax deduction for donating your asset to the foundation can count against 20 to 30% of your adjusted gross income for the year of giving to the organization. So there's a tax deduction for doing that as well. If you're selling a business, there is a wonderful tax benefit if your stocks qualify for the qualified small business stock and follows the rules there. Then the gain that is excluded on a stock sale, not an asset sale, it has to be a stock sale, is $10 million or 10 times the adjusted basis of the stock being sold. So if it's a C Corp and it's a business, there is the possibility of a significant tax advantage through the 1202, we call it tax code 1202, IRC 1202. But you have to talk to your attorney to make sure that the business and the stock actually qualify. It's not every C Corp that gets to use this tax code. Now, what about within the 1031 exchange's 45-day ID period? This is for those clients that are looking for the mailbox money. No more tenants, trash, toilets. A Delaware statutory trust. I actually have a lot of clients looking at this right now. It's a securities regulated investment. It's a more settled tax solution. They have an IRS ruling. Why was it easy to get an IRS ruling? Because the IRS actually developed this strategy because so many exchanges were failing. So they've provided a way to complete an exchange and not fail. You own beneficial interest in real estate and not the real estate itself. You're going to be one of up to 2,000 investors. It could be a long-term care facility. It could be a 500-door apartment complex. It could be a regional distribution center. I mean, there's a wide range of what those assets are. And then when you exchange into it, you get mailbox money plus future appreciation because you do not have to manage. They have the management in place. They have reserves in place to take care of improvements and repairs. So you're not getting those capital calls saying, hey, we need every investor to pony up $2,000 because we have to take care of this parking lot replacement or whatever it is, roof replacement. They have that in place. The government requires that they have all that in place. So you actually get mailbox money. If you're trying to just write off into the sunset, get the full tax deferral of 1031 exchanges, this is a great solution. The cost to set these up ranges from 8 to 15%. A group I work with, that's factored into the actual mailbox money as opposed to deduction up front. So you want to talk to a Delaware statutory trust professional that's really good at this. I tend to do the initial discovery calls to make sure that it is a good fit for the client. Now, you can exchange into and out of DSTs, but you don't have to. If you like DSTs, you can actually just invest into it. The key is that you have to be an accredited investor, which means that you have 200,000 adjusted gross income as an individual, 300,000 for a married couple, or $1 million in investments outside of your primary residence. So if you have a property that's worth $1 million and it's got 300,000 in debt, 700,000 of equity counts towards that $1 million. And then if you have 401ks and IRAs, that can count. So it has to be $1 million in investments outside of primary residence or income qualifiers. Typically, when you exchange into a DST, I have here that the purchase is not liquid. You could, depending on the group you work with, it's possible that you could sell out your portion of it sooner if needed. These are held 5 to 9 years. Most of them will have debt service with a balloon payment at 10 years. So they want to sell before that 10 years is up. And the reason for the range, some will say 6 to 8, 5 to 9, is they are waiting, the managers are waiting to find the right time to sell, where the market is the strongest, so everybody can get the appreciation. So if it happens to be a very good year to sell that type of asset, they may jump on it right away and everybody benefits. And then you can exchange into another DST if you would like. Now, here's where it gets to be a lot of fun, is the cash out DST. For some clients, they want full tax deferral, but they want cash to go play right off into the sunset. So if you do an exchange into a specialized DST that allows for the cash out, 30 to 90 days later, after you do the exchange, you can get a loan against that DST up to 85.75% of the equity you have. So now you have cash to go do what you want to with that. What's going to happen is, I mentioned that there is mailbox money that comes. So that mailbox money, instead of going to you, is now going to paying down that debt. But because that's still considered income, you have to pay the income tax on that money going to paying down the debt. But it is called phantom income. It doesn't go to your account. So you need to make sure you're doing well enough with the funds that you were able to pull out that you can pay the tax on the income that's paying down that debt. Now, you'll have 14% equity left in the DST that grows, plus debt is being paid down. So down the road, there will, would hopefully be not only enough to pay future taxes, but even more growth, that you have a greater asset net worth. So, and also because it's in DST, that step up in basis, if it still applies, can apply to your beneficiaries, and little to no taxes to be paid. So you get that tax deferral benefit. 10 in common, known as TICs, also securities regulated, co-ownership with investors with proportionate ownership of commercial real estate. 10 owners, 10% each. 10 owners, one's at 5, one's at 17, one's at 22, one's at 3. It can be proportionate. You can exchange into and out of a TIC, and you have direct ownership in real estate. And this, again, is passive income, mailbox money. Management terms are put in place, so you're not having to worry about getting that call that the water heater burst and flooded the garage and damaged all of your tenant stuff in the garage. And now they're really mad and coming after you. You don't deal with that. Now, a limitation is that you have to have unanimity of all owners in the decision-making process. I've been married 35 years. I guarantee you my wife and I have not always agreed. We've probably disagreed on things a couple times at least. And that's just 2 of us. You get 10 people that have to come to an agreement on a decision, that can be difficult. It could take 3 years to decide the color of the exterior of a building. As a matter of fact, I know of a case where a group was selling their TIC. All of the owners agreed to an offer except for one. One of the owners said, I'm not willing to sign off unless I make this amount of profit on this sale. All of the other owners had to give up $200,000 apiece to satisfy the one. That one person had a whole lot of control. And so, you just have to be careful with that. And then there's a lack of lending for TICs with more than 10 to 12 investors. Now, within this TIC world, If you're wanting to cash out, you can do what's called a liquid 1031 exchange into a TIC. So you exchange into a raw land TIC, tenant common, that is going to be developed. 30 to 90 days later, you can cash out. Now, groups I know that do this require a minimum sale of $1 million. You can cash out up to 93.5% within 30 to 90 days. And instead of like the DST, you're having to report income each year, but the DST is providing asset growth and value. Here, you have the debt, you're not having to pay it, you're not having to report income tax, but the debt, much like a reverse mortgage, continues to grow and will be addressed 20 or 30 years down the road. So you could cash out and go get that Tesla or go to Europe by doing a liquid 1031 exchange. All right, what if you have a failing exchange? You've identified a property. It's now the 50th day and you realize, I'm not going to buy this property. The inspection's really bad. What do? Well, there's a legal review on how to transition funds from tax code 1031 to 453. It's a really good review. The critical point is all this hinges on hiring the right 1031 exchange accommodator or intermediary, depending on what you call them, to begin with. Not all accommodators cooperate. For example, IPX is a wonderful 1031 exchange company. Wonderful. But their rule is complete the exchange or pay the tax. Now, they will tell you, go to a Delaware statutory trust so you can complete that exchange. But if you don't do that, you're going to pay the tax. They will not release the funds to any 453 strategy, structured installment sales, deferred sales trust, tax deferred cash out. So you have to have an accommodator that's willing to do that. Now, when I just mentioned deferred sales trust, this is the other DST. When people say, hey, I want to do a DST, I'm like, which one are you talking about? This is a form of an installment sale using tax code 453 that spreads out the payments. Based on the contract, you can get those payments over 2, 5, 10, 20 years, and they invest the funds. Can be used to purchase real estate, investment products, or a business. You pay proportionate taxes annually. Limitation is that you have no control. You need to understand this. This is why I don't think I've had a client ever do one of these types of DSTs. It makes sense to rescue, depending on one's needs and goals, but upfront in a sale, none of them have done it because when you do a deferred sales trust, those funds are controlled by a third-party trustee. You're considered a creditor of the trust. You are not an owner. As a creditor, you have zero decision-making power on the investments. If there are certain investments you really are concerned about really crashing and you're looking at it going, oh, I would never invest there. If they invest there, you can't stop them. So you could lose money. And hopefully not. People have made a lot of money on DSTs and people have lost a lot of money in DSTs. So, but you're a creditor of the trust. You do not have decision-making power. So the upfront cost is 1.5% of the first million, and then 1.25% of everything over $1 million. Then there's annual costs that go with that. This can be valuable in certain situations. Also, again, is it bad timing because you're spreading it out? Maybe you pay more taxes. If you are rescuing a failing exchange in California, they require that the title company withholds 3.3% of the sales price to go to the franchise tax board, and then you have to apply for that refund the following year. And then you have the $5 million per person rule, that anything over $5 million per person that is deferred, there's interest to be paid to the IRS. Structured installment sale, I've already gone over that, but that can be used to rescue a failing exchange. Tax-deferred cash out can be used to defer capital gains taxes for 30 years. It is a means to rescue a failing exchange, but can be set up in advance. You'll get 93.3% of the net sales proceeds in the form of an investment business loan, which means you can take and call your financial advisor and invest it or put it into business. Those are the limitations, but that's broader than real estate. The IRS is really scrutinizing very heavily the monetized installment sales and tax-deferred cash out. At this time, where we see more freedom is if it's in an agricultural sale, because there's a lot of that's been done into the billions of dollars. So it's not under scrutiny as much as, say, a business sale, or if you have property with a structure on it. So you have to be careful on this, very careful on this. So there's an easy as 1, 2, 3 strategy. You set up the exchange with an accommodator that will cooperate with 453 options if you want to have that flexibility. But again, many people, their flexibility is, if I can't find anything, I'm going to Delaware Statutory Trust. It doesn't matter who the accommodator is. You look for your 3 replacement properties. We recommend, again, that you designate a DST as a third property or backup. And if nothing good comes together, then you rescue it with one of the other strategies. But all that hinges on hiring the right accommodator to begin with, if you want that as an option. What if you've sold and you did not do a 1031 exchange? I get these calls too. I closed my property in November of last year. We're 5 months into it. Well, qualified opportunity zones could be an option. You take the gains from the sale of stocks, bonds, real estate, interest in partnerships, so businesses can work. You invest the gains only and you retain the basis. So if you paid $300,000 for a property, you have $700,000 in gains. You get to take that $300,000 back if there's no debt. Take that $300,000 back, put that in your pocket, and just invest the $700,000 in capital gains and get the tax deferral. Now, here's where there is some confusion. People have read that if you invest there, then you don't have to pay capital gains. Well, that is actually yes and no. Today's tax bill is only deferred until 2027. So you got to hope that the investment will pay you enough to pay the tax bill. So if that $700,000 of gains you give to the opportunity zone goes in, you still have to pay that gains tax bill in 2027, and they're working to extend that. However, that 700,000, if you keep it there in the opportunity zone for 10 years, then that's going to be federally tax-free, all the growth. So if that 700,000 becomes 1.5 million in 10 years, that 800,000 of gains while in the opportunity zone is federally tax-free. Some states cooperate, some states do not. In California, you still have to pay the 13.3% tax. They're invested into an opportunity zone within 180 days. If you have an LLC, your CPA may allow you to extend that 180 days after the close. It's invested in ground-up developments or substantially improved properties. You have to be an accredited investor. And this is to be set up and done separate from a 1031 exchange. You cannot exchange into opportunity zone properties to get the opportunity zone benefit. Charitable gift annuities. If you have sold, you can actually take a portion of your funds, donate it to a charitable organization that will give you a tax deduction. So if it's cash, you can count it against 60% of your adjusted gross income, up to 60%. If it's the asset that you're donating, you can only get a 30% deduction. Then what's going to happen is that charitable organization is going to take some of those funds and purchase an annuity. And then you're going to design how long you want that annuity to pay you out. And with the growth of that annuity, in that process, so you get the tax deduction, you have an annuity that's giving you payments over 5, 10, 20 years. You hope to get your money back in such a way that it washes out. So the money that you would have paid in taxes, you get that back through the annuity and the growth and deferral and all of that. So with this, there's no closing costs because the funds are going to a charitable organization, and buying the annuities don't have upfront costs typically. So it could be a good strategy afterwards. Cost segregation, if you've sold a property and you own other properties, you can accelerate depreciation, and that'll count against the income of your real estate investments, which could lower the tax bracket you're in with the capital gains. You depreciate subcomponents of your building at an accelerated rate. Why? Because fences and flooring and wiring and plumbing, they don't last for 27 and a half years or 39 years. So you can actually accelerate the depreciation, increase how much you're writing off in a year against the real estate income. This doesn't work to counter W-2 income, but it will counter investment income. You'll need to keep that property for 2 to 3 years if you do that to get the real benefits. And then there's a non-tax tax strategy. If you've already sold the property, you've got cash, you've got a big tax bill, maybe one way to ease that gut punch is to take some of those funds and put it into an annuity that ranges anywhere from a 10 to a 45% signing bonus. Now, that's not something you cash in. That will be applied to your lifetime income when you start taking those income payments from the annuity. There, like right now, I have access to an annuity with a 45% signing bonus. So $200,000 goes in, and one day it's $90,000. So you've paid the tax. This just helps to maybe ease that gut punch a little bit. We look at the numbers, the goals, and the personality. The numbers have got to make sense. If you are going to have a $100,000 tax bill and the cost to do the strategy is $84,000, it doesn't make sense to do it. So we have to look at the numbers. We have to look at the goals. A lot of people want to sell off their rental properties and pay off their primary residence mortgage. Well, a lot of the tax strategies will not work well. So we have to figure out the goals to see what is really going to make sense. And then personality. Some people would rather pay the tax and not have to deal with long-term tax reporting and all of that and all the restrictions. Other people will leverage every penny that they can to grow their net worth. So they will defer as much as possible so they can invest that. But many of those, not all of them, but some of them will look at the first group going, "You're an idiot for paying the tax." It's not a maturity issue, it's a personality thing. So I need to understand that. Then last, there's an income tax mitigation strategy. So if you have a high income or a high amount of gains, this may be, your CPA may allow this to be used to help mitigate some of the gains as well. It's a 4-to-1 leverage deduction strategy. If you're in the top 3 tax brackets for income, and then you add California, it makes it even better. And there is some benefit within the capital gains world on this. We can take $50,000, turn it into a $200,000 deduction. Typically with the organizations, it's $50,000 minimum to actually participate. It can count against 30% of one's adjusted gross income in a year. So if it's a $50,000 minimum, $200,000, to use it all in 1 year, you have to have an AGI of about $667,000. If it's short of that, it can be carried forward up to 5 years. So minerals organization will purchase minerals in a significant bulk discount in 1 year. They have to hold it for a year and a day. If they hold it for a year and a day, then all donations are based on actual market value. If they donate within a year, it's at the actual purchase value. So they have to hold it for a year and a day. Could be gypsum, magnesium, volcanic ash. I've participated with the latter two over the last 4 years. Then you join the LLC with a cash contribution, and then the next year you get then you're going to receive docs to sign off to be a member and you will elect either to have 6,000 gallons of magnesium delivered to your front door as a lawn ornament, or you elect to donate it to charity, which is what everybody's doing, because the purpose really is to get the tax deduction for the donation. And then you're going to get the K1 distribution along with the appraisal. There we go again with that appraisal stuff with the charitable donations at actual market value. It's a third-party independent appraisal. So in California, if you're at the top tax bracket, $50,000 can save you $100,000 in taxes. So it could be very beneficial. So even in Texas, if you're in the top tax bracket, it'll still save you $74,000, even though there's no state income tax. And then if it's capital gains, then it doesn't make sense with the 20% bracket unless you also have state taxes to add to that. There's always a limited amount of product available because they bought it 1 year and they have to hold it a year and a day. So we usually start that in the summer. There are 4-to-1 to 8-to-1 leverage deductions, and I'll tell you this: beyond 5-to-1, IRS red flags could go up significantly. 5-to-1, maybe not, depending on the strategy. Again, cost segregation can help with real estate income. This does not qualify for continuing education credits if you're hoping for that. If you would like a private presentation for your database, your prospective clients, I'll be glad to do that. Or if you have a real estate office or business brokerage office you want me to present for, I can do that. And then lastly, I'll hit escape here so I can see the questions a little bit easier. There's my calendar link. Just set up time if you want to have a chat with me. I do free consultations. So because they're free, you will always get your money's worth out of it. And then I also have an education platform, which we're building. We launched it in January, and we're going through a lot of capital gains tax strategies with interviews with professionals. I did 2 interviews in this past week with Alexandra. So we're adding a section for landlords, for investors. And we are set up to do more interviews with Alexandra next or in 2 weeks. So there's a good opportunity there to learn more in depth from different professionals. And I even have in there the dirty dozen mistakes of estate planning with an attorney with 8 episodes. So, but the key is if you're in real estate and you have clients that are a little hesitant because of capital gains, you can gift them 1 month or 2 months and say, hey, get on here. You're going to learn a lot to basically empower you to make some really good decisions. That being said, I'm done. All right. And then Alexandra just put up
All
the
right.
poll
Yeah.
there. Hi, Alexandra. You haven't changed.
Hi. I know it's been a while. So we have the poll question up. Please say yes if you want to consult, or if you can scan that QR code. Either way works. But in case you don't have a QR, you just want to say yes to the poll, that might be easier. So we put that up for you. Let's get into some questions here. I know we are a little over on time, but we'll see how many we can get answered. So we have here, Kobe, can an installment sale be used on a home?
Yes, I mean, you could do that owner carry for primary residence as well. But yes, installment sales, owner carries can apply to any kind of appreciated asset.
Great. David asking, what are your thoughts on a reverse exchange, and do you have any client examples?
On the reverse exchange, I think it could be very valuable because sometimes with the markets, it's easier to find a property to purchase and go ahead and purchase it. You still have to actually still sell your other property within the 180 days. If you need an attorney, this is where you have to get an attorney involved. A friend of mine just reached out to me. A friend of mine actually helped to co-author one of the provisions in the reverse exchange law. So he's the expert on this. But reverse exchanges, I'm seeing those more. I'm not an accommodator, but I'm seeing those more with clients.
Interesting. Um, let's see here. Alex, could there be capital gains or mitigation on a 1031 sale not exchanged in some way because it's in a divorce settlement? Any possible strategies? Oh, I think I lost you on sound here. There we go.
No. So who asked?
This is Alex Schutz.
Okay.
Yeah, thought that was interesting. I don't think we've ever covered how it works in a divorce settlement.
Yeah, so I'm looking as I can kind of capital gains or mitigation on 1031 sale, not exchanged in some way because it's a divorce settlement, any possible strategies. We'd have to talk, we might have to get, it depends on how the settlement is set up.
Hmm.
If you have a 1031 exchange property that you have acquired and you're having to let's see here. If you're forced to sell it because of a divorce, there are ways to address capital gains on it. If one person's having to buy out another person, that gets a little bit more complicated. But we'd have to get a tax attorney possibly involved in that. But
Okay.
it's all depending on how the divorce is also set up. But
Gotcha.
we can talk and I can pull
Okay.
in.
David asking if your 1031 timeframe is about out of time, you can't find a replacement property. Can you invest in a temporary property? How much time can you reinvest once you find another?
So if time is running out and you identify a property and purchase it, you need, depending on your CPA, you need to hold that property for a year and a day or 2 tax reporting years.
Hmm.
So you can't just turn around and sell it and buy. You have to be really careful on that. And if you're about to file an exchange, look at Delaware Statutory Trust. But that's more of a long-term option, 5 to 9 years.
Okay. Good to know. Leslie asking, can you do a 1031 exchange not at equal or greater value if you want to take boot and pay capital gain on the boot, but buy a lower price rental?
Absolutely. You just pay the tax on the difference.
Yeah.
Actually, I have clients do that regularly because they need cash. So they take some cash boot and then replace with
Uh,
the balance.
that makes sense. Yeah. I mean, it still cuts the tax bill, so it's not as bad. But David also asking, what are the cons or problems with DSTs? I think you covered that a little, but maybe in summary.
So depending on which DST,
Delaware
the
Statutory Trust, I'm assuming.
yeah, or deferred sales trust. With a deferred sales trust, the con is that you are a creditor of the trust. You have no decision-making power on how they invest your money. With a Delaware statutory trust, the only con that real estate's always a risk. So you always have to factor that in. They found that out in COVID. All real estate became a problem. However, it's the time of holding, 5 to 9 years. So, but I work with a person who actually has 5,000 investors to where they may be able to sell off their portion sooner than that if needed. But most people, you're locked in for a longer period of time.
Thomas asking, an installment sale on an apartment building, and I carry the loan. I only pay the gains on the payments and interest I take in through the year? Question.
Yes.
Also, the down for the first year?
Yes.
Okay. Easy.
As you
Um,
receive the cash, you pay the tax.
Makes sense. Okay. Jake, if you and your partners are selling a property, can you 1031 your own portion separately without the other partners?
Now you're getting into the drop and swap rules. Yes, you can, as long as your portion of the ownership is tied to you with your own tax ID number. If it's structured that there's one tax ID number with multiple partners, then no, You can't just go your separate ways because it has to be that tax ID number that goes on to the next property. But if you have 3 partners and they all have their own LLCs as in the 1/3 ownership, then you just take your LLC or your own personal tax ID number and go on to the next one. You can do it that way. That's a real problem. That comes up a lot.
Let's see, Kevin, can you use a 1031 exchange to purchase publicly traded stocks of a real estate company, such as Realty Income or American Tower, for example?
No, the 1031 exchange requires it has to be real property with its own legal description. And so you cannot invest into real estate investment trust or these types of investments that you're discussing.
Okay, yeah, that makes sense. Alex also was asking similarly if you can move any of the 1031 funds into a real estate building project.
Possibly that's where you really need to have a discussion with a tax attorney that knows what they're doing because they have build to suit types of 1031 exchanges, but those are tricky. Everything has to be done within that 180 days and funds closed. So you have to get real guidance from a tax attorney on that.
Okay. James asking, if I sold a property on installment sale and already received the down payment, can I set up a 1031 for the rest of the sale proceeds that will be received over time?
No, it all depends on who has responsibility for that property. If you've relinquished responsibility and they basically have ownership, in a sense, it's too late. If you're responsible for everything on that property, then you work with a tax attorney. They may be okay with you doing an exchange when those funds come in. I'm dealing with that with a gas station sale right now.
Oh, interesting. Okay. David asking, if you sell as 1031 exchange, if you held a note as part of the sale, is a note considered a 1031? Holding a note as seller financing, then sell the note later, what can happen?
Woo, boy, you got some good questions today.
Yeah, that's an interesting one.
All right. So you can carry a note if you for a buyer when you do a 1031 exchange. Now, but you have to with a lot of this, you really do need to get legal counsel because it's easy to make a mistake and the IRS disallow something. So you work with, the accommodator. Well, Ruth. I've worked with Ruth 30 years as an accommodator. You get somebody that knows what they're doing on that. I'm not an accommodator on that, but you have to be really, really careful. You can do it and carry a note, but you need to have legal documents keeping you out of trouble.
Okay, David asking, in a 1031 exchange, if you invest in Florida and you pay taxes in California, can you clarify what you mentioned? He asked this, I think around the time you were talking about just the whole tax structure. This was earlier in the presentation. Would there be anything to note about that if you're paying taxes in California?
So if you do an exchange from California to Florida, that works. It defers the California taxes as well. But income is still from Florida is still going to be taxed by California.
Gotcha. Mary asking, if you have a mortgage, for example, gross income is 100,000, the house will sell for 500,000. The mortgage owed is 300,000. Does that make my gains only 300,000?
No, debt is not factored into the gains. Contract price minus the original cost basis, minus any improvements. But debt, because people borrow against their assets all the time. So
Right.
now here's an interesting thing. If you have more debt than what you paid for the property and you sell, you may have what's called a debt over basis tax because the government says, hey, you utilized funds against your property so you can go play. So we want to tax you on that as well. And that could be up to 39.6%. If those loan monies were used to actually improve the property, that's not the case. So you have to talk to your CPA on that.
Okay. Leslie asking if you identify a property or three, but you're not under contract, can you replace the identified properties?
Yes.
Nice. Okay. Leslie also asking if you can tell us a little bit more about your educational platform.
So what I'm trying to do there is make it affordable for people to go somewhere and get a lot of information. Because like with the tax strategies, the capital gain strategies, people don't know where to go. When they come onto something like this, they're like, oh my gosh, there's all this. So I continue as I find more capital gain strategies. I'm actually interviewing professionals that actually are the one trick ponies that are specialists so people can learn. We're working on estate planning. We've already done living trust. We're going to add special needs trust, irrevocable life insurance trust. So estate planning so people can see that the breadth and depth of what's available. Income tax strategies, or even reverse mortgages, 4 episodes. Or how about landlords? I'm going to be working with Alexandra to have a lot of interviews there so people can learn. And so it's there. A lot of it was driven by the fact that a lot of real estate professionals around the country, they're working with clients and the clients are stuck. So here's a means that they can say, hey, get on this for a month or two and you can learn because the real estate professionals don't want to be getting engaged in the tax strategies. So this gives a place for the client to learn on their own at 10 o'clock at night.
Yeah, that's nice. It is I know because I did one. It is very short and sweet, but it gets I mean a lot of information out. So I do like learning that way. Miriam asking if you wish to do a 1031 on property owned by multiple people if they are each individually listed and one part is listed as an LLC on the deed, can each of them do their own 1031?
If they are each individually listed in the ownership, they can do their own 1031 exchange. But if the ownership is one tax ID number, then the only way to pull that off is if partners buy out the other partners in advance of the close.
Well said. Okay. Thomas, the other question is that setting up the installment sale, who do I get to make it happen properly? An attorney or a escrow? Who would be the best person or company to take care of the sale and protect me if the buyer fails? The property's in California and we are in Oregon.
You will likely want to get a real estate attorney to draw up the documents. And if you're working through a title company, they may have somebody that can do that because you want to have that well done legally.
Great. Yeah. And David was also asking if you had a referral for an attorney who knows 1031 and notes and an accommodator such as Ruth. So perhaps we can, have you connect with them with some referrals for those items.
Yeah, so actually what I could have done already, but I'll do this now, is in the chat box, there's my direct contact info.
Great.
Um, and so email me and I'll get you any referrals that I know of.
Wonderful. Okay, we'll share that in the follow-up email tomorrow in case you all don't get a chance to write it down. I will send it to you in that email. Keep an eye out for it. We have a couple more questions. Michelle, I just sold a primary residence with over $1 million in gain. Out of all the options you presented, where would you suggest putting the money to pay the least amount of taxes?
Okay, so over a million in gains, so you're gonna still have 500,000 that you pay taxes on. It's already sold. You can donate to do a charitable gift annuity so that you can get a deduction, or maybe you just take some of the cash that you had because it in California that would be about 188,000 in taxes. So what you do is take some of that money and put it into a annuity with a bonus, a strong signing bonus, so that eases the gut punch. Or you could take some of that and put it into an opportunity zone for a long-term plan. Feel free to reach out if you
Okay.
want to get more details on that.
Yeah, I really think a consult is going to be the way to go with a question like that. And, certainly encourage you all to reach out to Scott. He has a wealth of information and connections. And so, really just I love Scott that your goal is really just to help people to figure out like what to do and how to find the best solution for them because there are so many options out there that most people don't know about. And so, as long as you find something you feel really comfortable with that works for your situation, you're going to be in a better spot. And it never hurts to learn. So check out Scott's educational platform, schedule an appointment with him. He is generous with his time. I don't know how you do it, Scott, but you're always so busy and you still manage to take everyone's calls. So really thankful that you're generous with your time. I hope all of you on this webinar take advantage of that and really schedule some time with Scott to pick his brain and learn a little more. So Scott, thank you again for coming on and talking to everyone. We always appreciate having you.
Yeah, it's always a joy, especially working with AOA. Has been a really great relationship.
Yeah, we feel the same. All right, everyone, have a great day. We'll be with you next week on another webinar. So keep an eye out for that invite, the recording. We'll send it to you tomorrow with the slides and all of Scott's info. So again, thank you for coming and have a wonderful day, everyone. Bye.